You ever see a stock drop and have absolutely no idea why? That's kind of what happened with SoFi. On a day with literally zero news from the company, the stock still took a hit. So was this just the whole market having a bad day, or was something a little more deliberate happening behind the scenes? Let's break down what one analyst thinks is really going on.
A 1.5% drop? I mean, that's not exactly front page news, right? But when it happens on a day with no company announcements and very few people are even trading, that's when it gets interesting. It's like hearing a weird noise in a totally silent house. You can't help but wonder, where is that coming from? So let's start by just looking at the facts.
All right, so before we get into any wild theories, we need to see what the trading day actually looked like. What are the numbers telling us? Okay, so here's the raw data. A drop of nearly 1.5%, closing just a hair over 27 bucks. But the key detail here is the volume. Only about 24.5 million shares traded hands. That is super low. And on top of that, total radio silence from SoFi. No news, no SEC filings, nothing. It was a ghost town, which honestly makes that price drop seem even weirder.
And you know what? That quietness was totally expected. The source points out that this was right after the Christmas holiday, a time when things are usually slow. The big institutional players, the big money, a lot of them are still on vacation. So this lack of activity just makes that price drop stick out like a sore thumb.
So if it wasn't something SoFi did, the next logical suspect is, well, the entire market. Was everybody just in a bad mood that day?
And yeah, the market was definitely feeling nervous. The analysts saw four classic signs of fear. You had investors running for the safety of gold and silver while at the same time dumping riskier stuff like Bitcoin. Then you throw in some geopolitical drama with new US-China sanctions and a weakening dollar. It was basically a perfect storm of uncertainty.
So with all that chaos in the background, the simple conclusion is that SoFi just got dragged down with everything else. It was piggybacking, as the analyst put it, on that negative vibe. And for most people, that's where the story would end. But it doesn't.
Right. If the story stopped there, it would be pretty straightforward. But the analyst argues that this market fear wasn't the cause of SoFi's drop. It was the perfect cover for something else entirely.
And this quote is the key. The analyst recalls a time when SoFi would get hit with these bizarre, predictable sell-offs. It felt targeted, not random. And that historical pattern is what raises the suspicion that maybe, just maybe, this recent drop wasn't about market jitters at all. Maybe it was part of an old playbook.
Now, to understand that playbook, we got to quickly talk about options expiration. The simple version is this. Options are contracts that bet on a stock hitting a certain price, the strike price, by a set date. So if you bet the stock won't hit that price, you have a very clear, very powerful financial reason to make sure it closes even a penny below that number.
So with that motive in mind, let's follow the data trail. Let's look at the specific clues the analyst uses to build the case that this was targeted manipulation.
And here it is. According to the analysts, this is the smoking gun, the $27 strike price. There was a massive 9,000 open contracts, all betting the stock would finish above 27 bucks. For anyone on the other side of that bet, there was a huge incentive to push the price down. And the final closing price? $27.03. I mean, come on, that's suspiciously close, isn't it?
So who has the power to exert that kind of pressure? Well, this number is a pretty good place to start. 116 million. That's the number of SoFi shares being actively shorted, held by traders who are literally betting the price will fall. That's not just pressure, that's a financial army working against the stock.
But this is where the story gets really wild. The analyst found a major red flag. 116 million shares were being shorted, but only 105 million were officially registered as being loaned out. That leaves 11 million phantom shares. This points to something called naked shorting, an illegal practice where someone shorts a stock without ever actually borrowing the shares first. It's like selling a car you don't own and haven't even arranged to borrow yet.
And if that wasn't strange enough, check this out. The cost to borrow SoFi shares to short them was negative. Let that sink in for a second. Brokers were literally paying traders to bet against the stock. That almost never happens, and the analyst sees it as another clear sign of a coordinated push to keep that price down.
So we have two stories here, a nervous market on one hand and evidence of targeted pressure on the other. How does the analyst put these two pieces together?
It comes down to this two-force theory. The broad market fear wasn't the cause, it was the perfect cover.
It created the camouflage, and under the noise of all that general uncertainty, a targeted push was applied by short sellers to specifically attack that $27 option strike price. The two forces worked together beautifully.
So despite all this short-term drama and potential manipulation, the analyst points out that from a technical point of view, the stock's foundation is surprisingly stable. It's trading in a healthy, predictable range. This suggests that while there might be these daily battles, the stock's longer-term trend isn't necessarily in trouble.
So, that's the story. A quiet day on the surface, but maybe a targeted battle going on underneath. It's a powerful reminder that a stock's price doesn't always tell the whole story, and it leaves you with one big question. How many other quiet days are hiding battles just like this one?